In today's episode, I'll talk about three stories. In the first story, I'll talk about some things which are expected from the upcoming union budget. In the second story of the day, I'll talk about Bajaj Finance's latest quarterly results and what they exactly tell us about the space that it operates in. And in the third story of the day, I'll talk about the latest quarterly results of Maruti Suzuki and Tata Motors and therefore take a very quick look at India's automotive sector as a whole. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Friday, the 31st of January. Let's begin with the first story. See, tomorrow's budget comes at a very interesting time. The global economy is currently going through a rough patch. Growth has slowed down in many parts of the world. Even China, which once used to be famous for its fast growing exports, is pretty much struggling to find its feet once again. But during this time, India seems to be doing okay, at least when compared to other large economies of the world. In fact, India's economy might grow by about 6.8% in the coming financial year, which is faster than many other countries across the world. And while that may sound like good news at once, and in some cases it definitely is, if you look carefully, you will also see that there are some concerns here. For starters, foreign investors who used to bring money to India from other countries are not quite as enthusiastic as they once used to be. The amount of foreign investment coming in has dropped over the last few years, and that worries many people. Plus, people in cities are not spending as much money as they were before, and overall consumption is also slowing down. And in a time when global trade is shaky and it is not easy to sell goods to foreign markets, having fewer people spend money inside India can weaken our economy to quite a great degree. So the big question that's on everyone's mind is, how do we get past this tricky point? And that is exactly what everyone is hoping that this budget can answer. One of the first things people will look for is whether the government will make our tax rules simpler. Right now, India's income tax system can feel very complicated, and it also takes a lot of money from individuals in comparison to other fast growing regions across the world. For instance, some experts say that India's tax to GDP ratio, which is by the way a way of measuring how much tax a government collects in relation to the size of the entire economy, is around 19%. In many other Asian countries which grew quickly, it is closer to 14 or 15%.
The tax to GDP ratio in East Asia as a whole is around 14.5%. We are 19%.
Now, this difference suggests that the government might be collecting more taxes than is good for overall growth of the economy. And the thing is, if people have more money left in their own hands, they can spend more on goods and services. That spending can help boost the economy at the end of the day. Some economists also believe that the government could shift everyone to a simpler and a new tax system while reducing the rates that people have to pay. For example, the highest tax rate could be dropped from 30% to 25%, and the tax for people who are earning between 10 to 15 lakh rupees a year might be cut to 15%. They are also suggesting removing most exemptions except for important things like pension savings and medical insurance. But there is also a drawback to this. If taxes are lowered, the government might collect less money in the short run. Some estimates say that they could lose anywhere between 50,000 crore rupees to over 1 lakh crore rupees in revenue. And that is a huge sum by any stretch of imagination. But still, if it makes people spend more in the economy, it could help our economy overall, which might balance things out over time. Another issue that people are worried about is the decline in foreign investment. See, foreign direct investment or FDI is the money that comes in from outside the country in order to build factories, start businesses, or create jobs. Some figures show that in 2014, FDI was about 2.5% of India's entire economy, and now it has dropped to about 0.8%.
The last 5 years, or let's say when 2014, when the new government came into being, the FDI as a percent of GDP in India was something like 2.5%, which was one of the highest in the world. Today, or last year, it went down to 0.8%. 0.8. The last time India had such a low FDI to GDP ratio was in the mid-1990s.
That's a bit of a steep fall. And at this point in our growth journey, India needs this outside money to speed up our development because relying only on local funds might not be enough for major projects. Now, part of the reason foreign investors seem less interested in India might be due to unpredictable changes in our policies. For example, in 2015, India got rid of bilateral investment treaties. These treaties had allowed foreign investors to go to international courts if they felt they were treated unfairly. And after these treaties were cancelled, foreign investors had to rely solely on Indian courts, which can pretty much be slow as we all know. And that obviously made some investors a little uneasy. Now, the upcoming budget could be a chance for our government to show foreign investors that they want their money and we are willing to offer more stability. Now, this could mean bringing some form of these treaties back, making rules for foreign investments simpler, or even rolling out fresh policy announcements which attract global players. Then there's also the topic of exports. See, selling goods and services to another country can be a great way for an economy to grow. Even though the global economy isn't quite as strong as it should be right now, some countries like Vietnam are still finding success by making their exports more competitive. Many experts feel that India might be holding itself back with high import taxes on certain materials that local manufacturers really need. If it costs more for Indian companies to get their raw materials, they can't easily compete with foreign players on price or on quality. There are also plenty of rules and regulations that make it harder for businesses to expand globally. The government has tried encouraging domestic manufacturing through some programs that give incentives, but those haven't always worked out as planned. Now, looking at South Korea, where industrial policy was very closely linked to export performance, can teach us some useful lessons here. Now then, let's come to government spending. One of the most important things to watch out this time around is capital expenditure. This is when the government invests in building or improving things like roads, railways, and other forms of infrastructure. It can help put money in people's hands in the short run by creating jobs and paying contractors, and in the long run, this better infrastructure can help businesses operate a lot more efficiently than they currently do. Now, last year, the government said that it would spend over 11 trillion Indian rupees on capital projects, but they ended up spending around 9.7 trillion, which was a little lesser than they planned. Now, some people are hoping that in this new budget, the government will either match last year's original numbers or even increase it, because higher capital expenditure usually helps the economy grow faster and can encourage private companies to invest a little more as well. Finally, there is the question of balancing two important goals: maintaining fiscal discipline, which is when the government does not spend too much more than it earns, versus boosting growth by spending more money. Now, the government has made it a point to keep the fiscal deficit relatively low. They are aiming for a deficit of around 4.5% of GDP in the next year or two. And this is good for financial stability and could lead to better credit ratings for the country, making it overall cheaper for the government to borrow money in the future. But in a time when growth is slowing down, many economists believe that the government might need to spend more to stimulate the economy. So it's a tricky balance: spend too little and risk a slowdown, or spend too much and face higher debt. One thing that might help is the huge dividend of about 2 trillion rupees that the government got from the RBI recently. That extra money could allow some spending without completely abandoning the goal of keeping this deficit in check. With that, let's move on to the second story of the day and talk about the lending sector of India. Now, recently, Bajaj Finance released their latest quarterly results, and the reason it is important is because Bajaj Finance is one of the largest non-banking financial companies, or NBFCs, of India. And therefore, their quarterly results is somewhat like a big deal, because when a major company like this shares their performance, it can give us great insights about what might happen in the larger space that they operate in. Now, in the latest quarter, Bajaj Finance's AUM grew by 28% compared to the same time last year. This means that they handed out a lot more loans than they did before. They even added a record 50 lakh new customers and booked 1.2 crore loans in just 3 months. It is almost like convincing the entire population of two medium-sized states to borrow from them in one go, which is greatly impressive. But there's another side to the story that is worth noting for all of us. See, even though Bajaj Finance lent out more money, their profit margins were not as rosy. Their interest expenses, which is the money that they pay for borrowing funds which they in turn lend to us, edged up. They also had to set aside more money in case some people do not repay their loans on time. And because of these extra costs, the company's return on equity dipped from 22% to 19%. Now, for your quick reference, return on equity is a way of measuring how effectively a company uses its money to generate profit. So, a drop here shows that they had fewer challenges this quarter. But if you look more carefully at the challenges, one thing that stands out is the stress in their unsecured loans, which is the type of loan where a person or business borrows money without giving any physical thing as security. Bajaj Finance is specially known for giving out many such unsecured loans like personal loans or the popular no-cost EMIs you might have heard about in electronic stores. Now these make up a little over one third of their total loan book. And lately, more of these loans seem to be turning into NPAs or non-performing assets. And these, by the way, for your quick reference again, are when borrowers have stopped paying their money back. Now, their small and medium enterprise loans are also showing similar signs. And this is not unique to Bajaj Finance. Other banks and lenders like IDFC First Bank, Kotak Mahindra Bank, etc. have also hinted at stress in certain segments of their retail lending. Bajaj Finance has pointed out that rural loans and loans to certain businesses and professionals are areas that they will be keeping a closer watch on, even though they are not too worried about all of this yet. One more interesting observation is that Bajaj Finance has been expanding to new locations across the country for years, which gives them a massive customer base. Now, India is huge and many people and businesses still need loans. So, for a long time, a key factor in Bajaj Finance's success was that they kept moving to more and more and more places. But now they seem to be running out of completely new areas to tap into. They added only 14 new locations in the last one quarter, and they are well over 4,000 in total right now. So, this slower geographical expansion might mean that their rapid growth of around 50% every year could now slowly start to settle down to about 25% growth in the medium term. Now that's definitely good, don't get me wrong, but it's definitely not the same breakneck pace that they were once at. At the same time, they are also trying other ways of growing though. They have a new partnership with Airtel to offer loans to both retail customers and small businesses which use Airtel services, and this could help them reach new borrowers more digitally. On the other hand, they have stopped issuing co-branded credit cards with RBL Bank and DBS Bank, so it remains to be seen whether the Airtel deal makes up for the business that they might lose from their older partnerships. Now, in all of these changes, there is one part of Bajaj Finance's loan book that has actually shrunk instead of grown, which is the two-wheeler and the three-wheeler segment of loans. See, just a year ago, these loans made up over 6% of their lending, but now it is under 5%. And historically, Bajaj Finance got most of their customers from Bajaj Auto's showroom. Now, Bajaj Auto, for your reference, is part of the larger Bajaj group which manufactures vehicles, and Bajaj Finance used to work with them very closely. That arrangement was very convenient because buyers would often take a loan on the spot to buy a new scooter or a three-wheeler, and Bajaj Finance would finance it. As simple as that. But Bajaj Auto has created its own separate finance arm now called Bajaj Auto Credit Limited. And this change means Bajaj Finance no longer automatically gets all of those loan customers. In fact, they officially stopped originating two-wheeler loans from Bajaj Auto last October, and this caused the segment to shrink very quickly. Some people are also puzzled by the spike in NPAs for the two and three-wheeler loans. However, there is a simple explanation to this. Because Bajaj Finance is not adding many new loans in this category, the old bad loans now look much bigger when compared to the smaller pool of good loans. It does not necessarily reflect a major economic problem or falling vehicle sales, to be honest. It is more about how those numbers look when one part of the loan book stops growing while existing problems still remain to be. But overall, Bajaj Finance's latest quarterly results show both growth and challenges. They are still seeing a lot of demand for loans, but they have higher costs and are being careful about lending to riskier segments. With that, let's move on to the third story of the day and talk about what is exactly happening in the Indian automobile sector. See, recently, two of India's biggest and most prominent car companies, Maruti Suzuki and Tata Motors, shared their financial results for the third quarter. Now, like I said in the previous story as well, whenever companies of this size and scale publish their results, it is more than just numbers and charts. It also tells us a story about what consumers want, how the market is changing, what challenges are there, and therefore how the broad industry is doing. And that is why the results of Maruti Suzuki and Tata Motors offer some great insights into India's overall automobile sector. To begin with Maruti Suzuki, they reported a revenue of about 38,764 crore rupees in this quarter. This is an increase of about 16% compared to the same time last year and about 3.5% higher than the previous quarter. Profits were around 3,727 crores, which is about 16% higher again than a year ago and 20% more than the previous quarter. And while these numbers are certainly strong, Maruti's operating margin, which is the percentage of profit that the company makes on each sale before paying interest and taxes, took a small hit because the company gave more discounts than usual. Now, these discounts were meant to clear out unsold cars from dealer stock by the end of the year and keep Maruti competitive in the market. Top bosses at Maruti said that this step, although costly in some ways, was very necessary for them. And when you look closer, you can see how Maruti's different types of cars are performing. Their SUVs or sports utility vehicles are doing fairly well. And this might sound fairly obvious if you're familiar with the global trend where more people want larger and tougher looking cars. But there is an interesting trend to see here beyond that. Maruti's management has noticed that even in rural areas, people are getting more excited about SUVs now. These regions, which were once mostly dominated by smaller and entry-level cars, are now shifting some of their interest to bigger vehicles like SUVs. Hear what the Maruti CEO said.
Increasingly, we are seeing that rural is the trends are coming closer to urban also. But of course, we have got good traction for lower models, for smaller models like Alto. And rural is doing good in terms of growth, better than urban. So that is good. It serves as a de-risking for India consumption, not just for cars, but for all commodities.
Meanwhile, exports have been a bright spot for them. It has grown by 38%. Maruti sold about 99,200 cars overseas and earned over 6,500 crore rupees. They said that their success outside India is held by tailoring cars to suit the needs and preferences of drivers in places like Latin America, Africa, and ASEAN countries.
Exports has been a very happy story for us, and it has been a consistent effort over many years, and it is now showing good results. The growth has been fairly distributed across regions. We've had excellent growth in Africa, in Latin America, even in Middle East. The number is excellent, the overall share, and in ASEAN, it's well spread out across regions.
Maruti has also entered the EV space now by launching their electric Vitara called the e-Vitara. And the company does not just want to make electric cars, they also want to build a supporting network which includes easily available charging stations. Their management is confident that Maruti's large network of sales and service centers, combined with its experience in making small cars affordable, will give them an edge in the EV race of India. And that said, Maruti's recent performance can be described as having two sides. One side, SUVs and exports are powering ahead, and on the other side, entry-level cars, which once used to be Maruti's bread and butter, are finding it relatively tougher to attract as many buyers as they used to before. With that, let's move on to Tata Motors. See, it's very important to know at the outset that Tata Motors is no longer just an Indian automaker. Around 70% of its business comes from countries outside India. On top of that, Tata Motors has become India's biggest electric vehicle company, holding more than half the market share in electric cars. In this quarter, Tata Motors posted total sales of nearly 1,13,575 crores, which is only a 3% rise compared to the same time last year, but about 12% higher than the previous quarter. And that may not seem like much of a jump for you if you look at it year over year, but the sequential or the quarter over quarter growth was helped by JLR's strong performance, higher prices on some vehicles, and good demand for SUVs and EVs in India. The company's profit though went down by roughly 20% compared to the last year, yet it went up by about 67% from the previous quarter. And this year over year drop can be linked to a few important factors. First, Tata Motors faced higher warranty and quality costs. In simple terms, some problems with cars in key markets like the United States were costly to fix, and while the overall numbers of repairs went down, each repair was a little more expensive.
The balance, however, reflects the fact that although quality is improving and the number of repairs is falling, the type of repairs and the cost to fix them is rising.
Second, the company had to raise discounts to keep sales going, both in its domestic passenger vehicles and in JLR. This discounting is common when competition is tough or when there is extra stock that needs to be cleared from the showrooms. Third, the Chinese market was weak for JLR. Dealers there were stuck with more cars on their lots than they could sell quickly. Other well-known car makers like Volkswagen and BMW have also reported difficulties in China, so this is not only a Tata Motors problem. Many foreign automakers are battling intense local competition from Chinese electric car brands like BYD and are cutting prices to stay afloat, which then in turn hurts profits. But even with these challenges, JLR still had a fairly strong quarter. It earned 78,000 crore rupees, which is the most it has made in a third quarter over a decade. Wholesales rose by about 12% compared to last year, driven by the popularity of high-margin models like the Range Rover and the Defender. JLR did especially well in North America, where sales grew by 25%, but its Chinese sales dropped by 27%. Looking ahead though, JLR plans to keep pushing towards electric cars with the electric Range Rover slated to arrive by the end of this year. Within India, Tata Motors' passenger vehicle segment showed decent revenue growth, rising to about 12,400 crore rupees from 11,700 crore rupees in the last quarter. The company attributed this to new models like the facelifted Nexon and the general boost in buying that happens during the festive season. But profitability was under strain because the cost of raw materials in vehicles increased and discounts had to be given to meet sales targets. Among all their cars though, Tata Punch was a model that did exceptionally well. Tata Motors called it their best-selling model in India for the year 2024.
Punch, for the first time, was the number one model in the industry in the year 2024, a product which we launched in 2021. And also we remain strong number one in this financial year also so far.
In contrast, Tata's smaller hatchbacks and sedans struggled as more customers leaned towards SUVs. Tata Motors also continues to lead India's EV market, holding over 50% of that space. EV sales grew by 15% compared to last year, with cars like the Nexon EV bringing in a lot of customers. There was, however, a slowdown in EV sales to fleet operators, such as taxi services or corporate cabs, because of the reduced FAME 2 subsidies in India. Tata Motors said that it is working hard to expand electric charging stations in India, including a partnership with Tata Power and other charging providers. They see an easy and widespread charging network as crucial for getting more and more people to choose EVs.
How do you see the overall EV charging network expansion in India? Is the lack of this the main reason for lower EV demand, given that the pricing is not as high for EVs as versus ICE, the differential is not great? Will government subsidies for setting up the charging infra help expedite the network expansion? What's your sense?
I think, charging network expansion in India is, there are three parties who are really working on this. One is the OEMs themselves. The other are the oil marketing companies who have subsidy from the government already for the last 2 years, I would say, to build a charging infra of nearly 22,000. And the third are the, smaller startups like charge point operators and all.
Lastly, in commercial vehicles like trucks, buses and vans, Tata Motors saw some mixed results. Heavy trucks are not doing so well, but buses and light vehicles are holding fairly steady thanks to the increased public transport demand and more infrastructure projects around the country. The company's executive in charge of commercial vehicles sounded hopeful of the next quarter, partly because fleet owners may start buying more vehicles if freight rates and government spending continues to go up.
The utilization has started growing in all the segments on a quarter-on-quarter basis. Especially towards the end of November, there has been a good growth in utilization.
So when you put all of this information together, you see that two big auto giants are juggling both opportunities and obstacles right now. Maruti is enjoying strong SUV sales and promising export figures, but they are worried about a weaker demand for its smaller cars. Tata Motors, on the other hand, is growing in India, especially in SUVs and electric vehicles, while JRR remains a global powerhouse which is facing some bumps in China. Now, whether it is rural buyers picking up big SUVs or city buyers looking for more competitive discounts, the automotive scene is definitely shifting, and that is why it is a space that all of us must keep track of. With that, let's move on to the final section of the day and talk about the quick news tidbits. First, the Indian government has unveiled a 34,300 crore national critical mineral mission to secure essential minerals for industrial expansion. Of this, 16,300 crores come from government funding, including 2,600 crores in budgetary support, and 18,000 crore rupees is contributed by public sector undertakings. The mission plans to auction 1,200 exploration projects and over 100 mineral blocks by the 2030-31 financial year. Second, the government has raised the procurement price of C-heavy molasses ethanol by 3% to 57.97 rupees per litre for the 2024-25 supply year, while keeping prices unchanged for B-heavy molasses and sugarcane-based ethanol. India's ethanol blending has increased significantly from 38 crore litres in 2013-14 to 707 crore litres in 2023-2024, with an average blending rate now at 14.6%. Third, employment in India's unincorporated manufacturing sector remains below 2010-2011 levels. Although the number of such establishments have risen from 17.2 million to 20.14 million, the workforce has fallen from 34.9 million in 2010-11 to 33.7 million in 2023-24. This decline is attributed to challenges like demonetization, the introduction of GST, and pandemic-related lockdowns. That's all the news and stories I have for you today. I hope you enjoyed this episode and maybe learned something new from it today. This is your host Anurag Bansal signing off. I will see you in the next episode. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.